Hello and good evening and welcome. My name is Mack F. Blankenship Jr. and F stands for Franklin, and I am the Vice President of Mortgage Lending at Rate. And you know what? We really believe in empowering homeowners to take control of their financial future. And today we'll explore home equity conversion mortgages, also referred to as HECMs. And it truly is a powerful tool designed to help seniors utilize their equity and create freedom, flexibility, and peace of mind. Let's dive in and discover and see if we can open some doors to home equity conversion mortgages. So what is a HECM? A HECM is, as I stated before, a home equity conversion mortgage. It is a federally insured loan allowing homeowners at age 62 or older to convert their home into cash. Now, the unique benefit is no monthly mortgage payment is required, which can provide financial freedom for many seniors, especially those looking to enhance their retirement years. However, you are free to pay any and or all of the mortgage balance without penalty. And there is no catch associated with that. You are welcome and free to make any payments towards the principal without penalty. So why would you choose a HECM? Well, you know, the economy has been pretty challenging post-COVID with rising inflation and just higher costs. And, you know, many retirees face a gap between their lifestyle goals and their available income. A HECM provides an option to borrow from yourself, which is your equity, and eliminates the need for monthly mortgage payments, helping you to manage some of these rising costs. So is a HECM right for you? Well, the requirements are must be 62 or older, occupy the property as your primary residence, and own it outright or have a significant amount paid down on the mortgage. A HUD-approved counseling session is required to ensure you fully understand the program. Eligible properties include single-family dwellings, 2 to 4 units, FHA improved condos, and certain manufactured homes. So the requirements are, well, you know, the financial requirements in as far as income and credit history are considered to ensure timely payment for taxes and insurance. The loan balance grows over time due to interest and costs, but is paid off when the home is sold or the borrower passes away. So the amount you can borrow will depend upon several key factors, including the borrower's age, the youngest eligible borrower or spouse, current interest rate and home values, the home value, as I mentioned, and FHA limit or the home sales price for home equity conversion mortgages is also will also impact the loan amount. In addition, your current financial obligations. So with that said, we're going to open this up to Q&A, and forgive me for not introducing our guests, and we are going to do that now. Greg, please say hi and tell the audience a little bit about who you are and your background specific to home equity conversion mortgages.
Great. Thanks for having me tonight, Mac. My name is Greg Giannopoulos. I'm the National Reverse Program Manager for the Rate Companies, and it's a privilege to be with this group this evening. I've been in the mortgage business for just around 30 years, a little over 30 years. Spent the most of my career, the first part of my career, in traditional conventional lending, and then for the most recent 15 years, full-time on the reverse side. And I get both sides of the business, so it's a pleasure to share some of what I have to say with you this evening.
Great, thanks. And Carol, please introduce yourself.
Hello, my name is Carol Vera, and I'm part of Mack's team. And when it comes to reverse mortgages, so I would be helping you in the process. I've been doing reverse mortgages for the past over 10 years. I was doing regular loans before that. And so now I've specialized in reverse mortgages only.
Great. Thank you very much.
Mhm.
And this evening we're going to answer a few Q&A questions, and we're going to transition and turn this over to Greg to really dive into the financial benefits associated with this program. And what I would like to do is just reassure you that if you're doing a home equity conversion mortgage with Team Mortgage Mack and Mortgage Mack, we have experienced people who are passionate about this type of mortgage and helping seniors, maximize their retirement ability. So let's start with question number one, Greg, and let's see what we have here. A HECM is like a financial time machine, unlocking your home one equity dollar at a time. Sorry, that was the wrong note. So here's the question. Why save the, no. Uh-oh, I've lost track of my time, so we'll just edit that out. Q&A, what happens if my reverse mortgage loan balance? So let's start over, and I'm gonna make this introduction so we can use this Q&A later. Greg, what happens if my mortgage loan balance grows larger than the value of the home?
It's a question that most people think about as they unpack this product and begin to understand it. The key to remember, it's a non-recourse loan. Now, why would the mortgage balance grow? It's a growing balance loan. This is not a magical loan. It's not a free giveaway. It's the most flexible loan available anywhere, any type of loan product. Why is it flexible? Because the client has the ability to pay whatever they want when they want without penalty. You have the ultimate flexibility in setting your monthly mortgage payment. One of those options is to make no monthly mortgage payment. And that means you have a growing balance loan. So if someday the loan balance grows 20, 30 years down the road because you're an actuarial outlier and you live well beyond your average actuarial years, who knows what the real estate market might be 20, 25, 30 years from now. If for some reason the loan balance were to ever overtake the future value of the home, if that ever happens, that negative equity is completely forgiven. It's not even a credit event.
Wow.
It's a non-event.
Wow.
It's called the non-recourse feature. It doesn't matter if you have $2 million in your estate. You're not liable for it. You're fully protected and insured. You, your heirs, your estate. It's almost too good to be true, but that's the way it works, and people don't know it.
Great. What that is an amazing. I didn't quite fully comprehend the connection to the non-recourse aspect. That was amazing. So here's another question. What happens if I have a reverse mortgage and I want to sell my home?
Yeah, pretty much the same thing that would happen if you had a regular mortgage or a conventional loan on your home. You simply get a mortgage payoff from your lender, call the servicing department, contact your lender, get a payoff statement, and sell your home. And at the table, your reverse lender will be paid off. The remaining equity will be relinquished or released to you, the seller.
Okay.
Pretty much the same thing that happens now.
Okay, cool. Next one is what happens to my, and I'm sure this is probably a question for everyone would want to know the answer to this question. You probably know this question. What happens to my reverse mortgage when I die?
So most of us are used to a mortgage loan having a specific term. It's a 10, 15, 20, 30-year loan, right? The traditional 15 or 30-year fixed. Well, there is no term for a reverse mortgage loan. The term is very unique to every individual situation. The contract will say, the loan contract, that the loan will last, the loan term will be for as long as the last surviving homeowner is living in the home as his or her primary residence. Said another way, the loan term is for as long as it's needed.
Wow. Okay. Thank you for that, Greg. Well, let's move on to the next slide. And again, I'm going to leave this in your capable hands to share with the audience exactly the meaning and value behind the numbers represented here.
Sure. If you understand this slide, it's an interesting slide. You know a lot about the reverse mortgage business. On the vertical axis, we have percentage of the home's value. On the horizontal axis, we have ages from 62 up to 99. You can be over 99. There's just not that many people that make it that long. And what this slide tells you, whoopsie.
Uh-oh.
What this slide tells you is that the younger you are, the more the less you qualify for at the start of the loan. So someone in their 60s and 70s might qualify for roughly a third of the home value. Someone in their 80s, maybe around 50%. And as you get into 90s and above, maybe as much as 60 or 65%. The reason for the 3 lines on there is just to show you different ranges if interest rates are high, middle of the road, or low. The lower the interest rate would be the top line, because an interest rate environment is lower. Clients qualify for more funds at every age respectively. When interest rates are higher, they qualify for less. Just with market, we're kind of trending near the lower line, the 7% line down there.
So the interest rates have a direct impact on how much as a percentage of the equity that we'll lend?
To a lesser extent than the age of the customer, of the
Okay.
youngest customer, but it is a variable in determining the loan to value ratio, the percentage that's available to you at the start of the loan. But as
Wow.
we unpack this presentation, you'll see that over time, the reverse loan amount or credit line gets to grow. So it doesn't really matter when you start, but this is just to ground our viewers, to let them know how it works up front, the amount that you qualify for at the start.
Because that's a big difference between 31% and 41%,
Yes.
between 5% and 7%.
100%, and it
Yeah.
just changes with the market and Fed involvement, or the FHA involvement.
Great. Thank you for that.
Sure.
Next slide.
Okay, I love this slide, and for those of you that are not dialed in 100%, I would strongly recommend getting dialed in 100% for this. Mary, we changed her name and likeness to protect the innocent. She was a personal client of mine, and her agent referred her to us, and she had no idea what a home equity conversion mortgage was, didn't understand anything about reverse financing, didn't think she was even a candidate for the little that she knew about it. So let's frame this. Mary, at the time we did this loan for her, she was 64 years of age. She had $740,000 in savings, and she had $261,000 in her retirement plan at work. Mary was still working, and she intended to work till full retirement age, another 2 or 3 years. She wanted to buy a $700,000 home. Because she was working, she qualified for a traditional mortgage, okay? And that's option 1 that we'll talk about.
Column 1 right here, correct? Conventional purchase?
Yep, she had a contract for $700,000. In column 1, you see that we got her to qualify for $350,000, and she was comfortable making the payment on that. However, Mary would not be comfortable retiring, having that mortgage looming over her. So she didn't choose option 1. Option 2 was to pay all cash. She had enough liquidity to pay all cash. Remember, she's a renter right now, and she longed to come back home to southeastern North Carolina. She was living in just north of New York City, and she was a renter for 11 years. She wanted to come home. Her company gave her an opportunity to work remotely and relocate back home. When she came home, she had sticker shock because her hometown had escalated in value, inflated in value. She finally found a home for $700,000 that she liked. Everything she was looking at was $700,000 to $800,000. And if she had paid all cash, that would have significantly drained her savings, would have left her with $40,000 plus her retirement plan. Certainly not in dire straits, but probably a little uncomfortable going down that low with her savings. So she opted for column 4, which is H for P, HECM for purchase. Home equity conversion mortgage for purchase. We call it H for P or reverse for purchase. It's very counterintuitive for a lot of people. I thought you had to own your home to use a reverse mortgage. Well, in 2008, the federal government amended the program to say, you know what, home buyers out there, senior home buyers, you can use a reverse purchase money loan to help you buy the home that you really want. And Mary really wanted a $700,000 home. So instead of paying all cash or saddling herself with a $350,000 conventional loan, Mary ponied up some big money at the time, $430,000 down. She borrowed $270,000 with a reverse purchase money mortgage, okay, the P. But she still left a sizable sum of her liquidity in the bank, $310,000 plus her retirement account, which she's continuing to fund today. She's still working. And she's not making any monthly mortgage payments. She just has her monthly nut is $850 for taxes and insurance. And she's letting her mortgage balance rise. And instead of paying down her mortgage, which she could if she wanted to, she's aggressively saving and adding to her savings, to her retirement. And Mary is on track to retire on her plan. She's right on track. So her loan balance is growing. She gets a monthly mortgage statement every month. She reviews it, she files it away, but she has the flexibility to manage that debt any way she wants. And she significantly increased her cash purchasing power. Remember, folks, she's got no monthly mortgage payment.
Wow.
She put down $430,000 and she walked away and is living in a $700,000 home.
Wow. And no mortgage payment. And no mortgage payment. Wow. That's amazing.
Just taxes and insurance and HOA if it's applicable. HOA was not applicable in her case.
Yeah, that's amazing. In essence, she wiped out what would have been a $2,400 payment in the conventional purchase, right? That's what the payment was.
Yeah, that's what her payment would have been at the time on 350, about the same today. And really what's kind of interesting under option one, in order to get her to qualify for that much money on her good salary, modest salary, she would have had to take an early Social Security to qualify. You see that debt to income ratio is 45%.
Yeah.
Familiar with this? 45% is about the max. In order to get the max, she had to take early Social Security. If you notice column 3, we didn't increase her. She didn't increase her income. She didn't have to take her Social Security. Her base income is $5,300, and that was another benefit to her to delay taking Social Security during her working years.
Wow. Yep. Great story. Thank you for sharing
Love
that.
It. And she never would have known about this product had a professional not referred Mary.
A real estate agent referred her, correct?
After going through one of our seminars about 7-8 years ago.
Really. Yeah, I believe that this product for seniors there's just not a better opportunity for them to combine this with their current financial retirement plans. So thank you for that. You ready to move on to the next one?
Let's do it.
Here we go. We've got Margaret.
Yeah, so Margaret's another client that we just modeled this slide off of. I think Margaret was in California, 70 years of age. She is sitting on cash assets of 1.25 million. It's a different world out in California. Home values are expensive. And she wants to downsize, be closer to children, and the purchase price is $1 million. She qualified for a $300,000 conventional loan, but at her age, at the time we did this transaction, she qualified for 41% on a home equity conversion mortgage. That would be column 3. So kind of just jump into column 3 and we'll backfill. She ponied up a good deal of money, $591,000. Okay, she borrowed.
Sorry.
She borrowed $409,000 with the reverse purchase money loan, the H for P. But she still had over $650,000 in the kitty in savings. Okay, no mortgage payment. Those additional obligations are, taxes, insurance. Of course, you have your home maintenance, whether your home is free and clear or not. But column 1, had she done the conventional loan, she would have been saddled with a nearly $2,000 mortgage payment.
With DTI 68.08, she wouldn't have qualified.
Didn't qualify. Yeah, it didn't qualify there. So, and if she paid all cash, again, similar to Mary, she would have drained her savings. Mary wanted to be closer to family. The house that she purchased was right at $1 million, and she chose the H for P, the reverse purchase money loan. This loan is not about selling it to people. It's about helping them understand how it works and empowering them to make the decision which product works the best. And we can supply any of these options.
Amazing. Thank you. Next slide. Here we go. Henry, tell us about Henry.
Yeah, Henry, home improvements. How many people have a good bit of equity in their home and want to do some home improvements? And so that was Henry at 83 years of age. Whether it's ramps or bathrooms, just want to freshen the place up. He needed $200,000 for the work that he wanted to do. His home was worth just under 700. Yeah, there it is, 675,000.
Yeah.
Henry did not qualify for a conventional loan. His DTI was out the roof. You see it at 90% right there. So that wasn't even an option. But his home was free and clear. At the time we did this transaction, he qualified for a reverse loan amount of $353,700, but he took it in the form of a credit line, folks. He didn't need to borrow all that money. He borrowed the $200 that he wanted to do the home improvements, and the balance he just left in a credit line for him to access later, sort of a rainy day stash. Clients are not charged for the portion of the loan that they didn't borrow. Think of it, this example, as a home equity line of credit, as a reverse home equity line of credit in first lien position, where Henry only took out $200,000, he rolled in his closing costs, and then he left the rest in a line of credit, which is available to him to pull out at any time. And remember, it's all tax-free when you take it out
Wow.
with any kind of mortgage. Of course, we have to disclaim, consult a tax professional, but that's what the IRS code says. It's tax-free income.
Wow. Wow.
Mhm.
So out of the 353, so he had $353,700 available to him to repair to do the repairs, which would have been a 200, and that would have left him another 153,700 in an interest-bearing type account.
No, he didn't. We didn't fund that loan. It's just sitting there in an available credit line. He didn't take full utilization of what he qualified for. He took the 200 and he left the rest in the credit line. It's just available, and he sees that on his monthly mortgage statement. And we'll
Okay.
talk about it later. But that credit limit actually increases every month, every quarter, every year. So he's watching it go up, just like an interest-bearing account.
Clearly, for seniors that don't qualify for traditional mortgages that have a lot of equity, this is a better option than even a home improvement loan. And I never stopped to think that you could use a home equity conversion mortgage like you would use a HELOC or a home improvement loan or a cash out.
And we recommend our clients to borrow conservatively. You know, borrow what you want when you want it. There would have been no reason for him to fund the full amount and take that $353,000 and put 150 grand in the bank. Why should he do that?
Yeah.
Just because he'd be charged interest on that, unless he needed that money for something else. He can pull it out later.
Sure. Good story. Good story. Thank you.
Yep.
Who we got here? William?
Yes, William. Mr. William. He needed some in-home health care, some help around the house, like visiting
Really?
April, that type of thing. And so 85 years of age, William told us he didn't think he was ever going to live that long, and he doesn't know how long he's going to live, and really none of us do, right? Our job would be so much easier if we knew the date to which we had to plan. So we don't. He wants to remain in his home, like most homeowners. They envision staying in their home as long as they can, if at all possible. But he needs some help, and help is expensive. So he had a $550,000 appraisal, and he qualified for, you see that, just around $302,000 on the HECM. He would have qualified for a $150,000 loan potentially if we got his DTI down a little bit lower, but he would have been hammered with the payments. That wasn't even an option for him.
I
So
bet not.
what did he do? He drew $50,000 at funding. Remember, think of it as a HELOC, a home equity line of credit, a reverse home equity line of credit. He drew $50,000 at closing, and he set up a $2,000 a month tax-free monthly draw for 5 years. He said, just give me a 5-year plan. For 5 years, if I had an extra $2,000 a month tax-free coming in, that would work for me. Plus, he was sitting on an additional credit line of $131,000 that he had available to him. So, what a beautiful thing for William to be able to monetize a portion of his home equity safely and responsibly, and not being worried about being a burden to his family members.
Wow.
Stay in his home,
Wow.
and he has the resources to pay for help.
And I got to imagine that throughout the entire country that there's probably thousands, maybe millions of retirees that have equity in their home that have needs like this and have no clue that there's a solution like this for them.
They don't know about this, and if anyone who thinks about reverse, lay people and professionals alike, think that they give up the house to the lender, and they just don't. And we need to get the word out. There's a safe and responsible way to monetize a portion of one's home equity for one's well-being.
Well, that's what we're trying to do tonight. And so good stuff. Good stuff. Thank you, Greg.
Sure.
So you've said a lot, we've talked where you've mentioned Ernie and Rose to me a lot. So I'm really genuinely interested in this story.
Yes, thank you for teeing this up for me. So we talked about Mary before, and I said, if you're not dialed in, please get dialed in. I mean that plus on this, on the next 3 or 4 slides. Ernie and Rose are what we call part of the mass affluent demographic. They're not uber wealthy, but they have considerable resources. And let's frame this up. When they retired at age 67, they had $900,000 in their retirement nest egg. And their plan was to draw $50,000 a year from that portfolio to maintain their lifestyle, in addition to
Okay.
their income, which is basically Social Security. At the time when they were 67, their house was worth $600,000 free and clear. These folks were considered mass affluent because they have in and around $1 million in liquidity outside of home equity, and certainly not people that need a reverse mortgage. Okay. Now,
Okay.
they retired over 20 years ago. And we're going to advance, not the slide yet, but we're going to advance about 20 years in just a moment. But think about that scenario. The prevailing wisdom has been use your resources, spend down your $900,000, and then consider a reverse mortgage strategy as a last resort. Strategy number 1. But strategy number 2, what the data tells us, is a much better strategy. Don't spend down your portfolio all the way before going to home equity and or a reverse mortgage. Establish the reverse line of credit at the time you retire when you don't need it. And let's advance the slide. And before we unpack the next slide, we touched on it earlier. Folks, if someone took out a $300,000 credit line today, but didn't draw on it, just took it out and left it available,
Yeah.
in about 10 years, that credit limit will have increased to $600,000, and over 19 or 20 years to $1.2 million. So let me just say that again in a different way. If someone takes out a $300,000 credit line, and that's about what Ernie and Rose did over 20 years ago, that credit line would have an ever increasing credit limit month by month, quarter by quarter, year by year. And it would be about a $1.2, $1.3 million credit line today. And it is not a function of their future appraised value. Okay. It's just the way the program is designed. The credit limit on the reverse mortgage is designed to increase consistently over the entire loan term so that our borrowers, our seniors, can keep up with rising costs and expenses. That's why it's okay to take out a 30 or 35 or 40% loan, because over time it'll get much bigger. Now, I'm not going to read every line of this slide, and I'll just tell you what it's modeling here. And Ernie and Rose retired in 2002, and they were 67 at the time. And I love that they retired in 2002 because financial advisors hate this when clients retire and then the next year the market gets hammered. Remember the tech bubble of the early 2000s?
Sure.
That's what that was. Welcome to retirement. So you
That's
see
post
there,
9/11 too, wasn't it?
yeah, but it was just a total meltdown.
Yeah.
The market's melted down. So when you have a portfolio balance of 900,000 in 2002, that's a whopper. That's a big number. But when you draw 50,000 out, like you see that they did, according to plan, and then their portfolio lost $210,000 after 1 year retirement, their $900,000 portfolio was down to $639,000. You see
Wow.
that on the first line?
Yeah.
That's called sequence of returns risk. That's what financial advisors can't stand. And by the way, we pulled this strategy from the Journal of Financial Planning. We didn't concoct it ourselves. Now, You see the third column from the end, their $50,000 a year draw, they increase it 3.5% per year because of inflation, right?
Correct. Yes. Yes.
That's why that number does that. The third column from the left is just the S&P 500, just a very easily can be validated market performance, the S&P 500. So if Ernie and Rose took out $50,000 a year with 3.5% increases, they run out of business by the time they're 84 years of age.
Dang it.
That's okay.
I'm sorry.
You,
Yep.
you see that? By the time
Yep.
they're 84 years of age, they're out of money. And then the very last column, they could start drawing on equity, on reverse equity.
Wow. Wow.
Now maybe someone doesn't live that long, right? Or maybe they've sold, they've downsized. Maybe there's been a milestone event. One of them has died. The other one decided to leave. Or maybe both of them are the 1 in 4 of us that are living to our 90s and they're living and enjoying their home together.
Well, if they didn't live longer, it's because of the stress associated with not having any money if they did.
I was just going to say that as that portfolio is draining, they're losing sleep.
And the
Okay.
stress would just be beyond comprehension, especially if you're a married couple living in today's world. This scenario would just be immensely stressful.
Now look, they spent down $900,000. Okay. They still have an asset, their home, but this is what the math says. Let's advance the slide. That's the
Okay.
last resort strategy. There's a different way. What if first course of action, establish that reverse credit line when they first retire? Just establish it. Don't
Okay.
draw on it, just establish it. Remember the $300,000 credit line increased its credit limit to $600 and then to over $1 million. That's why we set it up early. Now we can't stop people from drawing it and using it, but if you're disciplined, you leave it there and you let it grow. Then what you do, very simple thing, you evaluate your portfolio at the end of each year. If the portfolio has gone up in value, take your next year's draw from the portfolio. However, if the portfolio, number 3, has gone down in value, number 3, if the portfolio has gone down and has gone up in value, take your draw from the portfolio. Number 4, if your portfolio has gone down in value, take your draw from the reverse credit line. And that gives your portfolio a chance to rest and recover. Now let's go to the next slide and overlay the same draw strategy. Except this time we're going to alternate between draws from the portfolio, which is the third to last column, and the reverse credit line, which is the last column. It's the same withdrawal rate. The only difference is after a down or red year, we're letting that portfolio rest and recover, and we're taking our tax-free draw from that growing line of credit. When you get to age 84, last time they had run out of money. At 84,
correct,
they still have $654,000 in their portfolio. And
show me at what year? At 84?
Yeah, they ran out of money at 84 last time.
Yeah.
At 84 here, they have $654,000. It's the same draw. They've done nothing different. The only thing they've done differently than the first iteration was instead of spending down their entire portfolio and then going to the reverse strategy, they strategically and intentionally used the reverse credit line to draw down and let their portfolio rest and recover. You just grasp that one concept. This is so simple and so compelling. It almost seems like, why doesn't everybody know this? Why isn't everybody talking about this? It's so compelling. I jump out of my skin every time I review it with anybody.
This puts seniors in just a much better position to just enjoy retirement without the stress associated with having enough money at the end of at some point in their life to sustain their lifestyle.
And for those people that have any experience watching their investments and savings, you know what happens when a nest egg has a market hit and then you draw down on it. it can't ever really recover. It doesn't have the
Sure.
time to recover. And in this data set from 2002 to 2022, we tried to break the model because we started in a year that the market got hammered. We carried the 1 in 100-year aberration of 2008 and the great financial crisis. And then we ended in an almost 20% down market, and they still had $500,000 left at 87. If we were to continue this out and model this out, they'd be back up to about 700,000 now.
Wow. Wow. That's an
With the
amazing
market
strategy.
performance
Thank you.
the last 2 years, folks. All I have the privilege is presenting this. This is so compelling for those that have loved ones or it can influence others to just take a look at this. We will unpack it. There's no sales pressure. We just want people to understand. Bring in family advisors. Bring in your financial advisor. This stuff is ironclad.
Beautiful. Thank you, Greg.
You're welcome.
Wow, that was amazing. And clearly, if you're a retiree, 62 or plus, have a lot of equity in your home, you know, this is a fantastic solution for you to help sustain and grow your retirement and, you know, continue in the current lifestyle that you're in. So with that said, should we do some more Q&A? So I have several Q&A questions. Would you be open to doing that with us, Greg?
Bring it on, and please don't hold back, folks. I've heard it all before, so none of this is personal. Ask me the tough ones.
Carol, Denise, any questions?
I have a question. So if we have someone that we would like to look into this, would they just apply? How would they go about, starting the process and applying for it?
Yeah, you just get up with Mac, and Mac will converse with our team, and we'll just tee up some scenarios, and we'll consult or co-present to the client. Yeah, very, very simple.
Yeah, I have a form to fill out internally, and I send it over to Greg and Carol, and they, based upon the data, I just have a little conversation with you, fill out the form, send it over to them. They'll prepare a formal proposal, and we can go over together, or we can all three go over together.
And it's a simplistic proposal, layman's terms. It's like a proposal letter. Try to uncomplicate this.
Yeah, you know, Greg, I can tell you that I've presented several of these last year to what I believe to seniors that really just, this was their only option. I have found one that actually has gotten to the point to where she's contacted me and didn't do the reverse or home equity conversion mortgage, and she didn't qualify for anything anymore. And then I've had another couple that I've met at a Christmas event, and they've waited and they've waited, and you know, now I've lost contact with them, but from my conversation with them is that, you know, they did the first scenario for, what was your Rose? What was your client's
Ernie
name?
Rose. Yeah,
Yeah,
Ernie Rose.
they did, you know, now they're running out of resources, and now they're considering a home equity conversion mortgage, but there seems to be a great deal of anxiety about that idea. Could you share with us where you believe that comes from?
Yeah, it's very hard to overcome because it's counterintuitive, right? It's borrowing is not something that we want to do as we age, but the math says differently. So it's emotional. It's when I did one for my own parents, and in full disclosure, they said, well, we don't need a reverse mortgage, and I said, exactly. Because although we're happy to serve those that need it, there's a whole massive amount, millions of people that don't need this product, that would just enhance their retirement dramatically without sacrificing legacy for their adult children or their heirs. If you plan it and you do it right. So it's just education. Don't be afraid of the unknown. Unpack it. Don't rush into anything. There's wonderful benefits, and we are committed to be responsible here at the rate companies in pointing out any risks or concerns that we see. There are times when we look at this for a client and we'll say, we don't think this is the right strategy for you, but we always tee it up for you to make and position you to make an informed decision.
Could you, on a different subject, or same subject but different aspect, could you give us maybe some perspective on what closing costs might look like?
Yeah, so depending on the transaction characteristics, value, how much is borrowing, the area of the country, it generally runs around 4% of the value of the house.
Okay.
Sometimes it's down around 3% or less, and in very modestly priced homes, it could be 5% or more of the value of the house. And there's three buckets of closing costs, but predominantly the largest single line item here is the FHA insurance premium. So it's not home insurance, but Uncle Sam backs this loan, and you want Uncle Sam to back this loan. Because if Ernie and Rose or my parents have a growing line of credit for a traditional loan, if that were even possible to have a growing line of credit, it doesn't. But any sort of traditional loan product, if the lender goes out of business, you don't have a credit line. Let me say that again. With a conventional loan product or HELOC, if the lender goes out of business, you don't have a loan. Okay? Not so with reverse. If you have an FHA insured reverse mortgage, not only is that insurance paying for the non-recourse feature, so you can't ever saddle your heirs with a debt after you die, or there's another important and very compelling reason why FHA insurance is so important, because if your lender goes out of business, and we're in solid footing, but who knows? Whoever thought Lehman Brothers would go out of business? Uncle Sam comes in and makes good on our obligations and that growing credit line. Okay? So as long as Uncle Sam has a shingle on his outside his door and he's in business, your loan is backed. Okay? So it's a wonderful, wonderful insurance, because presumably as we age, all of us, we can take on less and less risk. All the risk is offloaded from the aging homeowner and borne by the lender and backed by Uncle Sam with this product. And we've done over 1.3 million of these mortgages since inception. And there's so many millions more that want this product that just don't know they want it.
Yeah, yeah.
Um,
Yeah, and it's almost it's a scary idea to be 62 plus, or approaching your retirement and thinking about borrowing money. It's a scary. It's even at my age, it's kind of a scary idea.
That's because we've all been conditioned, stay away from home equity, and you don't want to risk foreclosure from payment shock because your payment went up, you drew too much. Now you're beyond the interest only period. Now you have a fully amortizing loan payment to make. You have other life's expenses, and then you risk foreclosure. Even if you had a great repayment plan for 10 years, if in year 11 you have an issue, you're on the foreclosure block. Not with this product. There is no payment shock because there is no mandatory monthly payment, but you're free to manage the loan balance any way you wish and pay it down as you go if you so choose. My own
Wow.
parents would take their required minimum distribution from their taxable IRA. If they didn't need that money, they'd take it or a portion of it and pay down their reverse mortgage loan that year just to maintain their mortgage balance.
Hmm. Hmm. Did someone have a question?
I do. As far as the fees that you mentioned, those are financed. So what are they're to be paid in the future when the loan is paid in full in the future. But what is the upfront cost to do this loan?
Yeah, thank you very much. I was talking globally at a higher level. Those costs are all financed into the loan. And so that's why we don't like these loans for short-term scenarios. If you think you're only going to stay in the property a year or two, it's a pretty expensive value proposition for a year or two. But if you're in the home for 10, 15, 20 years and you amortize the cost over that period, the cost of flexibility becomes very manageable. The upfront cost is very modest. There's a counseling fee, not to the lender, to an independent counselor, and there's also the cost of the appraisal, just like you'd have with any other type of mortgage product. Short of that, everything else is financed into the loan, but we actually disclose every fee right down to the dollar in the consultations and give it to you in writing. But thank you for asking that question. There's not a high barrier of entry to get the product. You don't have to come up with money to start the process and get the loan.
Beautiful. So they don't actually pay the closing costs at closing, is what you're saying. Is that
Yeah,
right?
they're
It just
financed. They're financed into the loan. Now, if a client wanted to, in theory, they could. Okay,
Okay.
but I think over the last 15 years, I've only had 2 people do that.
Okay. So here's another question. Can I use, let's see, with a reverse mortgage loan, can my heirs sell my home after I pass?
Yes, we touched on that earlier as well. It's a normal question. We get it a lot. The heirs can retain the home or they can sell the home. If they want to pocket the equity, sell the home, get a loan payoff, pay us off at the table when the home is sold, and the remaining equity goes to your heirs and distributed according to your wishes.
You know, and look, your heirs can refinance it. Actually, I have a transaction now where we have 4 heirs, and one wants to buy the home that the 4 heirs have inherited, and we're just going to do an OLTI deed, and he's going to refinance the home into his name and make it his own. And I assume that in that scenario, that if there was a reverse mortgage, we would have to pay that reverse mortgage off at that closing. But that would be a potentially real scenario that could exist in the real world, don't you think, Greg?
Not only do I think, yes, we see it time and again. Most heirs sell the home, but it's not rare for an heir to retain the home. All they have to do is pay us off through some other means, get their own loan, another refinance, pay it off with cash, whatever they have.
And they can refinance it even though their name is not on it, on the title currently. This is one of the exceptions as it relates to Fannie Mae's identity of interest, that if you inherit a home and we can put you into a loan, put you on title using the will as instead of the title as the identity of interest, source of identity of interest, and get a payoff from the estate, pay the estate off, pay the mortgage off, and it's
Yeah, you
yours.
just have
So
to be you have to be the rightful heir. And I'm going to add a little caveat. We touched earlier on this idea of non-recourse. If someday the home value is greater, excuse me, the home loan payoff is greater than the value of the house.
Okay.
So just very simple numbers. If the loan balance was $1 million and the home was worth $700,000, they don't have to pay off the $1 million in order to retain the home. They just get to pay 95%, get a short payoff. It's 95% of the home value. We'll do an appraisal and the rest of it is forgiven. Because HUD realizes that they want to disposition this loan. We're never going to get $1 million paid back if the house is only worth 700 or 750. It's just not going to happen.
Yeah.
So if the heir wants to keep it, very consumer friendly, very estate friendly, very heir friendly, we'll just give you a short payoff and we'll eat it all.
Wow. So even in that instance, if say the home was upside down from a value versus the actual loan balance, that you would give reprieve to the heir that was refinancing it into their name.
Yes, and they would pay 95% of the appraised value, even if the home was 140% of the appraised value, the balance, and it's forgiven. It's not even a credit event.
Wow, amazing. One more question. What happens if I have a reverse mortgage and I must move out of my home, such as into a nursing home or to live with family?
Okay. So going back to loan term discussion, the loan term lasts for as long as the last surviving homeowner borrower is living in the home as his or her primary residence. So once the home is vacated, once the home is no longer being occupied by one of the homeowners, the borrowers, that's when the loan comes due. That marks a maturity event. When there's a maturity event on a reverse mortgage, the loan needs to be repaid. There's up to a year to pay off the loan. It's not like, oh my gosh, I've got to get this thing paid off in 3 weeks or they're going to come take my house. No. And it's not like, oh, I'm going to do nothing for 11 months and I'll get it done in month 12. No, you work with our servicing department and you get a plan in place. I'm the heir, with the heirs, we plan on selling the property. You contact an agent that knows a little something about reverse lending, and you list your home. You send us the listing agreement, and the clock starts ticking. And we work with you. You have up to a year to get us paid off. That's typically
Beautiful.
enough time to have a disposition on most homes.
Beautiful.
Yeah,
Thank you. Thank you
You're
for that,
welcome.
Greg.
sure.
Very informative. Very informative. Thank you
Mhm.
very much for being here. And so I really do appreciate Carol and appreciate Greg helping me with this, helping me understand it, and helping me create some content. Denise, I very much appreciate you being here at any time. If you see some value in this product for you and your agents or anybody else that you might believe that this could assist and help in their planning for retirement or even in their current retirement, I hope you'll, reach out to me, and, my team and I would be delighted to help them.
Of course, Mac, I've worked with you before and I know I'm trying to send you some business.
I know you have, and I do appreciate it very much, and it means a lot to me. And you know me, Denise, I'm passionate about helping buyers, and in this instance, not necessarily, I guess, buyers, but let's just put it this way: I'm passionate about helping my borrowers.
Yeah,
So
I
with,
know that. And I
yeah,
appreciate, your passion for what you do. And so, I would love to work with you on some deals.
beautiful. Well, I appreciate everyone being here this evening. I hope you have a terrific and safe evening. And again, thank you and good night.
Yeah. Thank you. Good
Thank you
night.
so much. Appreciate it. Greg and
Thank you.
Carol, thank you.
Thank you very much.
Our pleasure.
Bye.
Good night.
Bye-bye.
Good night.
Bye.